Well, good morning, everybody, and welcome to our webinar and welcome to Sunny Accountants. This webinar is all about overcoming common payroll challenges, and I'm delighted today to be joined by Carl, who's the Managing Director here at Sunny Accountants. So welcome, Carl. Carl's presentation is going to last for approximately half an hour, where he'll talk through some of the payroll challenges that we're seeing with clients, and also sharing with you some of the best practices in relation to payroll. We will have a Q&A session when Carl gets to the end of the presentation this morning. So on your Zoom toolbar, you'll see an icon for Q&A. If you click on that, that will give you the opportunity to put your questions forward during the presentation, and we will attempt to answer as many of those live as we can before we finish. So I will now hand over to Carl, and I'll see you later for the Q&A session. So over to you, please, Carl.
Thank you, Jo, and good morning to everybody. So I know from first-hand experience that managing the payroll function of a business is time-consuming, fiddly, and often the source of a great deal of frustration. Payroll rules are ever-changing, increasing in complexity. Real-time information, or RTI, Auto Enrolment, and more recently the Furlough scheme are but three examples of how the workload has dramatically altered for a payroll department. During this presentation, we hope to go over common payroll challenges and how businesses can benefit from outsourcing their payroll function to a team of dedicated payroll specialists, such as our team at Sunny Accountants. So, the agenda, today we're going to be looking at upcoming changes to the national minimum and living wage. They are still happening, despite everything that's going on in the world. The complexities of furlough, the upcoming IR35 regulations, how to calculate redundancy pay, auto enrolment and re-enrolment, and finally the benefits of outsourcing your payroll functions. So at Sunny Accountants, we support a wide range of businesses with their payroll and HR functions. Our bread and butter is, of course, preparing pay slips and notifying employers of their liabilities to HMRC, but we go much further than that. Regularly offering advice on employment law, the rules regarding contracts of employment, auto-enrolment advice, whether that's setting up or the ongoing advice associated with auto-enrolment, and also advice on furlough. And these examples just scratch the surface, really. So by working with us, you can ensure that you can continue to remain compliant with the latest payroll and employment rules and avoid upsetting employees, HMRC, or regulatory bodies such as the pensions regulator, and their penalties for non-compliance are particularly punitive. So looking at the national minimum and living wage, just a quick recap on the minimum wage and the living wage. So the national minimum wage is the minimum pay per hour almost all workers are entitled to, while the national living wage, that's higher than the national minimum wage, and workers get it if they're over 25. But that drops to 22 and over from April this year. So the amount each worker is entitled to depends on their age, whether or not they're an apprentice. And regardless of the size of the organisation that employs a worker, all are required to pay the correct minimum wage. So national minimum wage rates are reviewed every year and typically change at the start of the new tax year in April. So hopefully you can see the slide of the current rates as they are now. What I just wanted to point out is regarding the apprentice rate, you're entitled to the apprentice rate if you're an apprentice aged either under 19 or 19 or over and in the first year of your current apprenticeship agreement. If you're 19 or over and have completed the first year of your current apprenticeship, you're entitled to the minimum wage for your age. So looking ahead to the upcoming changes then with the national minimum wage, they're often increased in line with recommendations from the Low Pay Commission, which reviews wage levels to ensure they're consistent with inflation and other living costs. So barring any last minute changes that are going to get announced in next week's budget, these rates are due to increase from April to the following. And you'll see that they've all gone up across the board. The national living wage, £8.91. So although referred to as the national living wage, this rate is not connected to the actual living wage, a rate which is calculated by independent organisations, which give an indication of how much a person needs to be paid in order to live in a given part of the country. Unlike the national living wage, employers are not legally required to pay the living wage, although some do use this advisory rate to determine pay. So calculating wages. When calculating pay, employers need to take into consideration any changes in the person's circumstance, such as a birthday and or costs deducted from a wage, such as where a person is required to supply their own uniform or equipment maybe. Commission counts towards minimum wage, and total pay including commission must meet the minimum wage each time a person is paid. This means that employers must top up pay if a person doesn't make enough commission to earn the minimum wage. Some parts of a person's pay do not count towards the minimum wage. These parts include tips and gratuities, premium payments, for example, extra pay for working bank holidays or overtime, a loan from your employer, or a pay advance. You may be required to make some deductions that could leave a person with less than the national minimum wage or national living wage take-home pay. This includes tax and national insurance contributions, paying back in advance or overpayment, pension contributions, trade union fees, a charge for accommodation provided by your employer. Penalties. So, employers who pay workers less than the minimum wage are required to pay back arrears of wages to the worker at current minimum wage rates. HMRC can also issue fines of up to 200% of arrears, and that is capped at £10,000 per worker. And lately, HMRC has decided to publicly name and shame the worst offenders. No doubt acting as a deterrent to avoid the reputational damage that could inflict upon a firm. Right, now we're going to look at furlough and the complexities of furlough. So although my payroll colleagues think the furlough scheme will never end, it is in theory at least due to end on the 30th of April. But I know in the news this week, I've been reading a few times that it's going to be extended until June or July. Don't think that will be official though until the budget next week, but I can't see it ending on the 30th of April. So the furlough scheme undoubtedly has been a massive success, supporting around 10 million workers in the UK during the last year. Employers can currently use the HMRC dedicated portal to claim for 8% of furloughed employees' usual monthly wage cost. And that's capped at £2,500 a month for any hours not worked. However, they must pay for the associated employer national insurance contributions and minimum automatic enrolment employer pension contributions on that wage, as well, of course, as any wages for hours that are worked. Any UK organisation with employees can apply for the scheme. That includes businesses, charities, and recruitment agencies where the agency workers are paid through PAYE. Publicly funded organisations are not expected to use the scheme, but partially publicly funded organisations may be eligible where their private revenues have been disrupted. Employers across the UK can claim whether the business is open or closed. So in terms of employee eligibility, the scheme is open to all employees. Neither the employer nor the employee needs to have used the old furlough scheme previously to use the new extended scheme. The scheme will otherwise operate as it has done previously, and it will be open to employees on any type of contract. You'll also be able to top up employee wages above the value of the furlough claim if you wish to do so. There's no maximum number of employees you can claim for. Employees can work for any amount of time and any work pattern and claim the grant for the furloughed hours, with reference to hours the employee would usually have worked in that period. This means furloughed employees will be able to work reduced hours, paid by the employee in full, while the employer can claim the furlough grant in respect of 80% of the pay for usual hours not worked. Although flexible furlough agreements can last any amount of time, unless otherwise specified, the period claimed for must be for a minimum claim period of 7 consecutive calendar days. You will need to agree a full furlough or flexible furlough arrangements with employees in accordance with employment law and their contracts of employment. So how businesses claim. The extended furlough scheme operates as the previous scheme did in several respects. Firstly, employers must report and claim for a minimum period of 7 consecutive calendar days. Secondly, employers will need to report actual hours worked and the usual hours an employee would be expected to work in a claim period. Finally, for hours worked, employees will be paid by their employer subject to their employment contract, and employers will be responsible for paying the tax and national insurance due on those amounts. And sometimes annoyingly, the claim period must also start and end within the same calendar month, often creating extra work for pay dates that run from the 6th to the 5th. Where the pay period includes days in more than 1 month, separate claims will need to be submitted, covering the days that fall into each month. These claims should be calculated separately based on the specific rules and contributions for that period. A claim can be made in anticipation of an imminent payroll run, at the point an employer runs the payroll, or after they've run the payroll. Claims relating to each month should be submitted by day 14 of the following month, unless this falls on a weekend, and then it is the next working day. So you'll need a HMRC Government Gateway account to make the claim. These are fairly quick to set up, and an HMRC login Google search usually finds the correct page as the top search. If your claim is particularly time consuming or you're prevented from completing your claim in full, you can save a draft, but it must be completed within 7 days of starting it. And businesses looking to make a claim can do so now via HMRC's portal, and they're going to need to be registered for online PAYE, to have a UK, Channel Island or Isle of Man bank account number and sort code, and the billing address on your bank account will also be needed to make the claim. This is the address your bank statements are delivered to. You'll need your employer PAYE reference number of employees being furloughed, each employee's national insurance number, each employee's payroll or employee number if there is one, the start date and end date of the claim, full amounts that you're claiming for, which include employee wages, employer national insurance contributions. That was only for claims up to the 31st of July 2020 though, likewise for pension contributions. And then you need to give some contact details, phone number, contact name. And you also need to provide either your name, your corporation tax UTR, self-assessment UTR, or company registration number. If you're claiming for employees that are flexibly furloughed, you're also going to need the number of usual hours your employee would usually work in the claim period, the number of hours your employee has or will work in the claim period, and you'll also need to keep a record of the number of furloughed hours your employee has been furloughed for in that claim period. So moving on to calculating a claim, employers are responsible for calculating the correct amounts to claim from the scheme, with HMRC expected to take a hard line on errors that are not corrected quickly. Claims do get checked, usually by phone. Several of the claims that we prepared for clients have already been checked, so it is happening. The amount you should use when calculating 80% of your employees' wages for hours not worked is made up of the regular payments you're obliged to make, including regular wages you paid to employees, non-discretionary payments for hours worked, including overtime, non-discretionary fees, non-discretionary commission payments, and piece rate payments. You cannot include the following when calculating wages. Payments made at the discretion of the employer or a client, where the employer or client was under no contractual obligation to pay, including any tips, including those distributed through the trunk system, discretionary bonuses, discretionary commission payments, non-cash payments, and non-monetary benefits like benefits in kind, such as a company car, and benefits received under salary sacrifice schemes, which includes pension contributions. There are plenty of HMRC example claims within the Coronavirus Job Retention Scheme section of their website, and they cover various degrees of complexity. So just looking at some of the other furlough considerations, the entirety of the grant received to cover an employee's subsidised furlough pay must be paid as money and should be netted off to pay for the provision of benefits or a salary sacrifice scheme. Where the employer provides benefits to furloughed employees, these benefits should be in addition to the wages that must be paid under the terms of the job retention scheme. Employees cannot switch freely out of most salary sacrifice schemes unless there's a life event. However, HMRC has confirmed that coronavirus counts as a life event that could warrant changes to salary sacrifice arrangements if the relevant employment contract is updated accordingly. If you receive an overpayment and you're making further claims, it is possible to offset the overpayment against the amount of your next claim, and your new claim will be reduced, and you'll need to keep a record of the adjustment for 6 years. If you don't intend to make another claim, you must obtain a payment reference number and pay HMRC back within 30 days. If you don't do this, you may have to pay a penalty, and it will prevent any potential tax liability in respect of the overpayment of the furlough scheme. If you made an error in your claim that's resulted in you receiving a smaller grant, you must still pay your employees the correct amount and should contact HMRC on or before 30th of November to amend your claim. For claims relating to periods after the 1st of November 2020, you'll only be able to increase the amount of your claim if you amend the claim within 28 calendar days after the month the claim relates to. Unless this falls on a weekend, then it's the next working day. Employees that were employed and on the payroll on 23rd of September 2020 who were made redundant or stopped working for their employer afterwards can be re-employed and claimed for. You must have made a PAYE RTI submission to HMRC from the 20th of March last year to the 23rd of September last year, notifying a payment of earnings for those employees. Likewise, an employee who was on a fixed term contract on payroll on 23rd of September and that contract expired after the 23rd of September can be re-employed and claimed for, provided that the other eligibility criteria are met. Employees returning from statutory maternity and paternity leave in the next few months will remain eligible for furlough through the Coronavirus Job Retention Scheme, as long as they meet the existing criteria. However, employees who wish to return early from maternity leave to be furloughed with the agreement of their employer must give 8 weeks notice. So directors of a company can be furloughed. During any furlough period, directors should be careful to avoid anything that could be mistaken for work, such as promoting their business on social media. It is, however, okay to reply to your accountant's emails. When furloughed directors need to carry out particular duties to fulfill their statutory obligations they owe to the company, they may do so, provided they do no more than would be judged reasonably necessary. Employees can be furloughed where they're unable to work because they're shielding in line with public health guidance, or need to stay at home with someone who is shielding, or have caring responsibilities resulting from coronavirus, including employees that need to look after children. So the furlough scheme is not intended for short-term sickness absences. If, however, you want to furlough employees for business reasons and they are currently off sick, you are eligible to do so as with any other employee. Furloughed employees who become ill due to coronavirus or any other cause must be paid at least the SSP rate. It's up to employers to decide whether to move these employees onto SSP or keep them on furlough at their furlough rate. In the majority of cases, it will be the employee's interest to accept an offer of furlough, as it means that their role would otherwise be made redundant. Employers have a variety of options open to them, including reducing their working hours, reducing their pay, short-time working and layoffs, and in some cases redundancy. Remember that existing employment rules continue to apply, so you must consider whether your actions could lead to a claim for unfair dismissal or discrimination. Grants from the various government schemes to provide support during the coronavirus outbreak are taxable in the same way as any other income. A separate line on the profit and loss account, such as other operating income, grant income, is the best way to keep these receipts separate from turnover. You must also deduct and pay to HMRC income tax and employee national insurance contributions on the full amount that you pay employees, including any scheme grant. So now we're going to look at IR35 and the upcoming IR35 regulations. So again, barring any last minute changes, the piece of legislation known affectionately as IR35 are coming in from the new tax year in April. So these are changes that were introduced within the public sector in April 2017. And our experience of that was almost all of our contractor clients were either forced to use an umbrella company or switch to an employed contract with the customer, the firm that they was actually working for. From April, in most cases, the engager, the employer in other words, will be responsible for deciding whether to deduct tax and national insurance from freelancers and contractors who operate via a personal service company, as if they're employees. It negates the whole tax benefits of running through a limited company. So the old rules place this responsibility on the worker, in other words, the contractor himself or herself. So that's the major change. The new rules don't affect small businesses, as defined by the Companies Act 2006, where they meet 2 or more of these criteria. Annual turnover is no more than 10.2 million. A total of fixed and current assets over 5.1 million, or no more than 50 employees. So the estimate is that almost a quarter of the UK's workforce now works on a contingent basis, either in the public or private sector. And so businesses must be prepared for the changes ahead. So the role of the engager. Engagers are required to undertake this IR35 determination for every contract they agree with a worker. So the official guidelines are as follows. Pass your determination and the reasons for the determination to the worker and the person or organisation you're contracted with. Make sure you keep detailed records of your employment status determinations, including the reasons for the determination and fees paid. Have processes in place to deal with any disagreements that will arise from your determination. So the government has created the useful assessment tool, CEST, C-E-S-T, that can be found by typing CEST HMRC into Google. And this can be used to assess whether a worker is a contractor or deemed employees. And a report can be printed out as a record of your assessment if challenged by HMRC. If the determination results in a contractor being within the IR35 rules, you'll need to deduct pay you'll need to deduct and pay tax and national insurance to HMRC via the PAYE scheme, negating almost all benefits of using the PSC in the first place. So preparing for IR35. Where an employer fails to correctly identify a disguised employment scheme, the workers' tax and national insurance contributions become their responsibility. Where you hire a contractor via an agency, it's the responsibility of the closest intermediary to the PSC to calculate, deduct and pay tax via PAYE on the contractor's remuneration. There are some basic steps that all businesses can take to help them prepare. So, conduct an audit of freelancers and contractors. As it will be the responsibility of the person engaging the services of the contractor to determine whether their work falls inside the new rules, you should carry out an audit of all employees and contractors currently working within your business to determine who may be affected. Determine who falls under the rules. Last year, many businesses were simply assuming all freelancers were caught by the new rules, but recent research suggests that more and more companies are taking a more measured approach to ensure they aren't disadvantaging and potentially losing those contractors. You'll need to determine whether each contractor falls inside or outside of the new rules. And this should be done on a case-by-case basis, as you could face serious repercussions for failing to demonstrate reasonable care to correctly classify such roles for employment tax purposes. If the engager fails to correctly determine status, they will be held liable for any tax or national insurance charges and could face a penalty from HMRC. Communicate all changes. So once you've determined whether a person falls within the rules or not, you should communicate any change to them. It's important to demonstrate that you're taking reasonable care to assess their status. If you determine that a person should be within the new rules and you switch them to the PAYE system as required, they'll no doubt see their take-home pay reduced considerably. These conversations should be handled sensitively, I would say. There is a disagreement procedure that's been created by the government to be used by the contractor and the organisation paying the fees in the event that all parties do not agree with the determination. Create an agreement policy. Businesses should prepare an agreement policy for new contractors they take on from April 2021, which clearly outlines the contractor's employment status. Existing contractors might also need their agreements adjusted in light of the IR35 changes if they run into the new financial year. And consider the costs. Many contractors have indicated that they intend to increase their daily or hourly rate to compensate for the tax and national insurance being deducted by employers. You should discuss this with the contractors as soon as possible so you can factor any additional costs into your employment budget. If you rely on the services of contractors or freelancers, it's important that you prepare your payroll systems and processes for these changes. And if you do need any support with the transition to IR35 next year, then please contact us. We're of course happy to advise and assist any contractors or freelancers who are also concerned about the changes. So redundancy may become the new buzzword when furlough finally ends. Let's hope not. If the decision to make employees redundant is made, then once you've conducted the necessary consultations and agreed who is to be made redundant, you'll need to calculate redundancy pay for those affected. You must pay redundancy to employees who have an employment contract and have worked with you for 2 years or more. However, the following types of work do not qualify for redundancy pay: armed forces, crown servants, and domestic service where they're a member of the employer's immediate family. Police and apprentices who are not employees at the end of their training. So calculating redundancy pay, you must pay at least the statutory legal minimum amount to your employees, but how much redundancy pay each employee gets depends on their age, how long they've worked for you, the weekly earnings before tax, and the redundancy pay is also capped at 20 years. So working backwards from the day of the redundancy notice, you must pay 1.5 weeks pay for each full year they were 41 or older, plus 1 week's pay for each full year they were 22 or older but under 41, plus half a week's pay for each full year they were under 22. The maximum for a week's pay is £538. The maximum total amount of statutory redundancy pay is £16,140. It's worth mentioning, though, that gov.uk have a statutory redundancy pay calculator available online that will crunch all of the numbers for you after you've answered a few simple questions, so you don't need to memorise all of the above. Do remember to check employment contracts because they may stipulate an amount of redundancy pay above the statutory minimum. And you can also choose to pay higher amounts if you want to encourage voluntary redundancies, for example. Where an employee's pay changes from week to week, calculate the average weekly pay for the previous 12 weeks from the date you made them redundant. If they didn't work for a whole week during that time, for example, they're on holiday or off sick, replace it with an earlier week. You must share in writing with employees how you've calculated redundancy payments. And your employee's weekly pay should also include regular overtime if the employee's contract says they must get paid for it, and any bonuses or commission. Redundancy and furlough. So since 31st of July 2020, any furloughed worker that loses their job is eligible for redundancy pay based on their normal wage, rather than what was paid via the furlough scheme. New legislation will ensure that workers get the full rate of redundancy pay after it emerged that a small number of employers had taken advantage of the coronavirus crisis to pay employees the same rate they received under the furlough scheme for the redundancies. So the new rules on redundancy pay also apply to statutory notice pay, which covers the period before a worker's employment ends. This paid notice period typically varies from 1 to 12 weeks, depending on an employee's length of service. Under the new legislation, notice pay must be based on an employee's normal wages rather than the lower wages they may have been paid under the furlough scheme. The legislation also ensures that basic awards for unfair dismissal cases are based on full pay rather than the reduced wages under the furlough scheme as well. So to find out how we can help with calculating redundancy pay and liabilities that may arise from it, please speak to a member of our payroll team. Now we're going to look at auto enrolment. So the government wants to encourage more workers to save for their retirement rather than simply relying on what is becoming an increasingly smaller state pension. Wants all employees to be automatically enrolled into a workplace pension scheme if they're not already in an equivalent scheme, with employers required to contribute to each individual's pension fund. Anyone aged from 22 to the state pension age and earning £10,000 per year or more should by now have been automatically enrolled into the employer's pension scheme. Those who fall below this threshold can still join and receive employers' contributions, but employers are under no obligation to enrol them automatically. Those aged under 22 should automatically join the scheme when they either reach that age or start earning above the threshold. Employees can choose to leave a scheme at any time and any pension built up will stay in place, although they won't be able to get their contributions back. While an employee can opt out of a workplace pension scheme, employers still need to initially enrol them and re-opt them in regularly. Workplace pension contributions, so auto enrolment began several years ago, and there's been a number of changes to the amounts that employers are required to contribute. Up until April 2018, employers only had to contribute 1% of the employee's salary into the scheme. However, changes to minimum auto enrolment pension contributions means that employers must now contribute at least 3% and ensure that staff receive contributions equal to 8% of their wages. It's up to the employers whether they contribute the additional 5% or whether it's provided by employees themselves. As an employee, you can choose which provider to use. We use Nest for most of our clients, but they're just one possible provider of pensions via auto enrolment. Just bear in mind, it may not necessarily be the best scheme for your business. Providing an existing scheme meets the minimum standards for auto enrolment, then you can continue to use it, although you will need to register it with the pensions regulator within 4 months of your start date. So re-enrolment's cropping up more and more, obviously, as the auto enrolment initiative progresses. Re-enrolment and redeclaration must be completed every 3 years. You must re-enroll staff who have left your workplace pension scheme or reduce the contributions back into the scheme and complete a redeclaration of compliance. The declaration must be completed within 5 calendar months of the 3rd anniversary of your original staging date. Auto-enrolment and re-enrolment are not optional, and as an employer, you have a duty to offer your employees an appropriate scheme. Employees can choose to leave the scheme if they wish, but you're legally obliged to offer one in the first place, and you could face substantial fines and even a prison sentence if you fail to comply. So just wanted to quickly touch upon payroll automation. So automation in payroll wraps around existing processes, applications and data to reduce costs and bring in new efficiencies. It allows your payroll team to share the workload between human and digital workers, with the latter handling the repetitive tasks and the former handling interpretation and decision making. We think payroll's perfect for automation because it works well with processes that are recurring and heavily rule-based. Automating payroll allows business owners and their accountants and business partners to spend less time on back office operations and more time building businesses or providing more careful financial analysis. So we're very excited about the potential savings in productivity by automating some of our payroll clients. And we'd be delighted to hear from anyone who's looking to dramatically reduce the time they're spending on payroll tasks. So what are the benefits then of payroll outsourcing? So while many management teams attempt to go it alone, and that's fine if that's working for you, there are a number of benefits that come from outsourcing payroll functions to an experienced accountancy firm. At Sunny Accountants, we already work with a wide range of businesses from various sectors to deliver effective outsourced payroll services. We literally have clients with 1 employee on the payroll to clients with hundreds. So many firms have spoken about the added value that these services provide to them and the peace of mind they get from having our team support them. So here are just some of the reasons why many of our clients have turned to outsourcing with us. You've got lower employment costs. Hiring a person, whether you need them full-time or part-time to carry out a specific role such as payroll, can be very expensive. By using outsourcing, a firm can reduce its need to recruit and lower employment costs, as well as saving on costs such as sick pay, holiday pay and pension costs. Not only that, but is your payroll department working flat out for 100% of the time you're paying them for? In my experience, the answer is usually no. Continuity of service. So many companies may only employ a single person to fulfill their payroll function. When that person's unavailable due to sickness, holiday or another reason for absence, then there may not be another person to fill their role. Often this means that the responsibility falls back on the business owner. By outsourcing, you're guaranteed greater continuity of service thanks to the larger team that's available within a firm such as Sunny Accountants. Scale. Businesses may not need someone to fill a permanent position. By outsourcing, businesses can call upon expertise as and when they need it, adding members to the team during growth periods and then reducing the level of service they use during the quieter periods. Experience and expertise. By using a team of experts instead of a single person employed by the business, owners are able to call upon a wider range of knowledge and experience, including more senior team members. Our qualified staff are obligated to maintain their professional knowledge by carrying out what is known as continual professional development. You can be assured that we're up to date with all of the recent legislation and case law. Connections. By working with the payroll team within a firm of accountants and tax advisors, businesses often gain access to experts in other fields who've got close connections or the expertise to deal with difficult or obscure matters. This may include quicker access to trusted advisors in other fields such as employment law or recruitment. Reduced overheads. By having fewer employees, businesses require less office space and equipment, which can help keep overheads such as rental costs down. And also those monthly Sage subscriptions can come to a stop. They don't get any cheaper. Reduced accountancy fees. So we are usually able to reduce our fees for the preparation of the annual accounts, where we also prepare payroll for that same business. The reasons for this include the fact that our payroll software integrates with our accounts preparation software, which is saving us valuable time. The reconciliation processes that we carry out on payroll are also quicker to complete when we've also completed the payroll in-house at Sunny. And we can pass these time savings on to you in the form of lower accountancy fees quite often. Systems improvements. By working with an accountancy firm, you're likely to find that they have ways of improving your payroll systems using the latest technology, including cloud accounting. This means that you may have better access to the information you need to run your business. Sunny Accountants offers a secure portal, for example, enabling a speedy, secure transfer of data such as pay slips, P60s, etc., between us and our clients. Additional advice. Our experienced team will be well briefed on the most tax efficient way that a director should be paid and be in a position to advise on optimal salary levels. Help with HMRC. So the cost of defending a challenge from HMRC can be considerable, and every business is likely to receive an enquiry at some point, even where it has acted within the rules. By having a team of outsourced specialists on hand, you should be able to resolve issues quickly and accurately without having to seek out additional advice elsewhere. Save time, reduce stress. So one of the main benefits of outsourcing some of your business functions to specialists, such as the team at Sunny Accountants, is to save you time and reduce the pressure on you as a business owner. The payroll is time consuming, fiddly, and however small the mistake will be discovered, often by the employee, causing more work and possible conflict. Assuming the business can afford it, we feel that a business owner's time is much better spent working on developing the business rather than getting bogged down on payroll tasks. So it's coming towards the end now, as this presentation has hopefully demonstrated. Managing a compliant payroll can end up taking over your working life. While many firms choose to go it alone in-house, there are clear benefits from having experts on hand to provide advice and support with payroll issues. The last year has seen considerable change to the way employees are paid, which has required businesses to adapt quickly. Further changes are expected in the years to come, especially as a result of Brexit and the COVID-19 pandemic. To ensure you have the support you need to remain compliant and to reduce the stress of managing a payroll, why not let us help you? Our fees are probably cheaper than you think. For example, we have clients paying as little as £12 a month for their entire payroll function. So to receive your own bespoke quote, why not give us a call or drop us an email? Okay, that's the end of the presentation, but stick around if you can. I'm going to hand you back now to Jo for a quick Q&A session.
Great, thank you very much, Carl. Well, we've got a few minutes left. So we've had some questions come in. I'm going to just fire these through to you. First one is in from Jane, which is she runs her own limited company and wants to make herself redundant. Can she pay herself the 30k as a tax-free redundancy payment?
Well, I'm assuming that she's a director of this company. In that case, to receive a tax-free statutory redundancy payment, a worker must have an employment contract with their employer, and they cannot resign or leave of their own accord. So even if the director satisfies the first condition and does have an employment contract, which is quite rare, it has to be said, there's another issue to consider. As the owner and director of the business making themselves redundant, they're effectively making the decision to cease trading and leave, and so fail the second condition. So unfortunately, the answer to that is no, I'm afraid not.
Okay. And a question coming from Bolsover Antiques. No. What is the situation with the employees' holiday entitlement this year, as it appears that obviously businesses will be closed for over 3 months?
Well, the guidance around holiday entitlement is that whilst you're on furlough, the employees continue to accrue holidays as if they were normally working. Yeah. So the holiday entitlement's unaffected. And I know myself from my firm, I've got a lot of staff that don't actually want to take any holidays at the minute because there's nowhere to go and nothing to do. So it does seem to be building up a bit of a backlog of people that's going to be wanting holidays when we do start to get back to normal.
Yeah. Okay, another question here from Harry. I think we need to close my company now due to IR35, which obviously you touched on earlier. Can you help with that, and how do I get the cash out paying the least amount of tax?
Yeah, I can definitely help with this. We've gone through this process several times. I think, as I mentioned in the presentation, IR35 came out in the public sector a few years ago, so I've got contractors then that were wanting to close the company. What we tend to do is we tend to do it through a system known as a members voluntary liquidation. This is the most tax efficient way of doing it because we can normally claim entrepreneurs relief on extracting that cash, which results in a 10% tax rate. And that's after the first 12,300 comes out. So if you've got 50,000 in, it'd be 50,000 minus 12,300 times a 10% tax rate. I have got my eye on the budget though, because there has been some rumours that that particular loophole is going to close, but only time will tell on that because it's just a rumour at the minute.
Okay. I'm just going to squeeze in this last question before we run out of time, which is a question here from James. When can we claim the £1,000 job retention bonus for keeping staff on?
Right, well, this £1,000 job retention bonus was actually abolished when furlough was extended at the end of last year. The Chancellor, it didn't throw it out completely. His exact wordings were, we'll look at that again in due course. So it's a case of watch this space on that one.
Okay.
But as of now, it doesn't exist.
Yeah. Okay. Question here from Colin. Joe, we have a couple of employees in a cloud-based payroll system. If we moved over to Sunny, would you handle conversion of the data to your system?
In short, yes, we'd give you whatever support you needed in doing that. Yes, we'd sort of hold your hand through the whole process, yes.
So the answer is yes. Okay, thank you, Colin.
Yes.
Okay, and one more. This is come in. Can you please update me, as I just came to know that after the 6th of April, if a contractor falls inside IR35, then they require FCSA accredited accountants. So is that true? And if not, why do many agencies want this type of accredited accountant? And do you have that certification?
It's the first time I've heard of this FSCA accreditation, to be honest. It's not something we've got. It's an accreditation that's normally used for companies that work under the umbrella agency type arrangements or agencies, but it's not an accreditation that accountants themselves tend to have now. Okay.
All right, well, I'm conscious of time. We've run a few minutes over, only a couple of minutes over. I just want to say thanks a lot, Carl, for the presentation today. Thanks everybody for attending and thanks for the questions. We will make a copy of this webinar as a recorded on-demand version available on the website either later on today or tomorrow morning. So if you want to recap on anything Carl said, it will be available to you. And obviously, if we can help, there's Carl's email on the screen. I'd be delighted to talk to you. So please do get in touch. So thanks very much, Carl.
Thank you.